Hello and welcome to the Currency Exchange, NatWest Markets FX podcast, where we help to break down the major themes and events driving currency markets this week and in the weeks ahead. Today, I'm joined by none other than our European head of G10 FX strategy, Paul Robson. It's been a very interesting week in the UK this week. We had one data point in particular, June CPI, which almost promised to be a watershed moment for the UK. And we really saw, UK financial assets really react in response to it. Paul, why was, this June CPI, why did it promise, such hope for the UK?
Well, I think, as you say, it was clearly an important piece of data. The reason it was important is that recent inflation prints have been consistently higher than expected. And it's not that inflation was quite low to begin with, and it was just a little bit higher. Inflation in the UK was very high already, and it seemed to be tracking higher. And the UK looked to be increasingly an outlier, certainly in the major economies where inflation had started to come lower, certainly core inflation. Why it was attracting so much attention is that markets were pricing in an ever higher terminal rate, peak rate, in the Bank of England policy cycle. There was increasing worries about mortgage refinancing risks in the second half of the year and what impact that would have on the overall economy. Certainly households that have traditionally got used to low interest rates and are having to refinance it considerably higher. The fact that it came in weaker than expected just soothed some of those worries. Now, one swallow doesn't make a summer, but if you put it in the wider context of inflation coming down, I think that might be a thing we might pick up later in today's podcast. I think it's markets have moved to price out some of that Bank of England tightening. What made the release so sort of dovish or soothing for markets? Well, it's the core inflation number and the service sector inflation number. The core, you strip out all the things that the Bank of England can't really influence, like fuel, tobacco, alcohol, those kind of things, and concentrate on the impact of monetary tightening. The service sector inflation number, sort of indicator of domestically driven inflation, again, something that the Bank of England feel that they can influence. And both those were lower than expected, and they slipped back for the first time since the beginning of the year. And they were also for the June. Remember, June was that nice sort of warm month. It was the best month of summer. The rest of the month, summer has been a little bit poor in terms of the weather. But that could have been an opportunity for retailers and the service sector to increase prices as we all went out and enjoyed the warm weather. Well, that didn't happen. So this is an important release in terms of Bank of England expectations. And from here, it's about to what extent we can expect a 25 basis point hike at the August meeting, or whether the Bank of England will continue with their 0.5% increases. Remember, they did that and they stepped up in the previous month. And on balance, we don't think there's not enough in this inflation numbers. There's a little bit weaker. But when you think about slightly higher than expected inflation was enough for the MPC to move from 25 to 50 basis point clips, the fact that it's just come down a couple of tenths, if they do shift down a little bit to 25, it's a bit of a credibility. It's sort of people will be uncertain about the inflation forecasts and their reaction function, and financial markets don't like sort of uncertainty. So we stay with the 50 basis point hike, rates up to 6%.
And I guess it comes off the back of obviously the weaker than expected US CPI print last week. So kind of playing into that narrative that, hopefully we are coming to the end of inflation. It is easing lower. Do you think markets could be potentially getting a bit too carried away, especially when you look at kind of pricing for the Bank of England?
In terms of global markets, I think it does have a feel of the beginning of the end. So I talk about the UK as being, one swallow doesn't make a summer, but I said exactly the same for the US, and there's been a couple of them. So if these swallows get together and form a flock, apparently it's a kettle or a flight or a gulp of swallows. I had to Google that before coming on to today's call. I should really know that. being an avid watcher of Autumn Watch and Spring Watch on the BBC, which is highly recommended. But you get the sense that you've got more confidence in the global policy tightening cycle is over. And for FX markets, that's potentially going to be important as we move through the coming quarter. It will be increasingly be about which central banks have scope to cut interest rates the most and how quickly. And as my colleague Alvaro was just saying to me the other day, it's about where real rates, when you adjust for inflation, where are they looking just too high? And ultimately, central banks will have to get them lower. And as we know, yields are very important for FX rates. And we think that that's going to be a developing theme and may not be a particularly well understood theme for the second half of the year.
And we certainly saw, sterling really react to that data yesterday, really dropping lower, below 130 against the dollar. What do you think are the biggest things to watch for now and the biggest driver of sterling?
Well, just going back to that sort of interest rates outlook, we do think that sterling underperforms other European currencies. We think it remains relatively stable against the dollar, but that's more of a dollar view than specifically for sterling. And we think that CPI number just reinforces that underperformance theme of sterling. Sterling has tracked interest rate expectations. I mentioned it in terms of all the currencies, and sterling has been the same. We did wonder whether we were going to get a slight shift from yield to worries about growth. I was talking about like a titanic battle between yields and growth, Titanic with a small t, not a capital T. But what markets have latched on more is straightforward nominal yields. They've gone up, sterling went up, they've come down after that CPI number. And we think that's probably the way forward, just try and keep it simple as possible. But if we get a situation where inflation's coming lower, the interest rate hikes that the Bank of England have already have put in place haven't really impacted the economy yet. We think that increasingly that growth will be weak. You've got a bad combination of lower yield, weaker growth, and ultimately we think that weighs on the currency. One bigger picture story, which I think that markets might be not concentrating on enough, is positive balance of payments dynamics. This is something that I think I bored lots of people with for the last 6 months since we published our year ahead in November. But the trends are quite positive there. And I don't see many people, hear many people talk about it. And this is an unwinding of the energy crisis, unwinding of COVID, a shift from goods to services in the economy, and deflation of the domestic economy relative to the rest of the world. And that improves the balance of payments position. And why is this very important? Well, sterling has tracked market expectations for the balance of payments for this year. It's actually the inverse of what you would normally expect. Normally, you would expect the currency to go up and the balance of payments to deteriorate. But at the moment, we've got improving balance of payments and we've got a strengthening currency because people were worried about the balance of payment situation. And it does mean that sterling might find it a little bit easier to negotiate some of those headwinds, which are weaker growth and the impact of slightly lower yield. So I think that's a bigger picture thing, but short term, it's very much about nominal yields. And I think you just have to keep it simple.
I think, at the moment, markets are definitely fixated on interest rate differentials. But I know you've made kind of the great call before that risks just to sterling are asymmetric when you think about stagflation and the risks on either side. It is kind of, we've got a bit of a gap until the August Bank of England. Is there any kind of other drivers you're particularly focused on or any kind of events before we get to the big central bank day?
No, just watching the data. I think sterling is going to be sensitive to indicators of whether demand in the UK is holding up. We've talked about this lagged transmission mechanism of the rate increases that we've seen from the Bank of England and the refinancing of mortgages, and to what extent that starts to weigh on the economy. And on some measures, the impact is going to be quite severe. But you've got offsetting factors like savings. You might even have intergenerational transfers, parents to their children, grandparents to the grandchildren, that are just helping people find a way to get through this sort of cost of living shock and refinancing. But if those demand indicators start to deteriorate again, if consumer confidence starts to weaken, then I think that gives you a little bit more confidence that sterling is going to head lower against those European currencies that we've spoken about. My personal favourites are, seeing sterling weaken against Norway, for example, of Sweden, because valuations are extremely high, and this sequencing story, which I personally find very, very compelling. But those demand indicators, so watching the data very carefully, any signs that the consumer is finally cracking, I think will lead to further weakness in the currency.
And I know we're talking about, for most of the G10, central banks are now approaching the very end of their tightening cycle. Well, we have kind of the complete contrast when we talk about Japan, and all these expectations they could actually finally begin to actually tighten very loose monetary policy. What are your expectations going into this kind of critical central bank meeting next week?
Well, as you say, I think the important bit of what you just said is growing expectations that the Bank of Japan might tweak its yield curve control framework and some of the parameters on that. And that has happened at a time when the Japanese yen has actually been outperforming. So dollar yen lower, squeezing some of the speculative positions in the market. So this meeting is important. Now, we don't think anything changes. We think that there's just the Bank of Japan just simply won't have enough confidence that inflation is going to stay high beyond this year. Now, this year, they probably have seen they've seen the data. It's been stronger than expected. Wage growth has been strong. It's feeding into higher service sector inflation generally. And at that meeting, they will probably revise up their inflation forecast. But it's what they expect in 2024. That's ultimately going to be what decides the market impact of this. And our Tokyo economists don't think they're going to be confident enough. And you had the governor, Ueda, just this week, just saying they don't have enough confidence. Now, of course, they could surprise, but really they don't have enough confidence in inflation being higher. He had said a similar thing at the ECB Sintra conference just a couple of weeks ago. So it would represent quite a marked change without a lot of data. So renewed yen weakness, I think, might be the outcome of next week's Bank of Japan meeting. But it's definitely one to watch.
I think you always see kind of market expectations really building into this, that, Japan has to be the next one to jump on the tightening trail. But I guess you have to remember that Japan has just always suffered historically with, deflation. And for them, actually a little bit of inflation is just, a gift, essentially. Guys, that is about all we have time for today. Paul, thank you so much for joining me. And if you did like the podcast, please do click like and remember to subscribe so you get the latest episode first. Thanks again.